Namaskar. This is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The provision and management of optimum liquidity in the economy through the banking and financial system is one of the key functions and objectives of the monetary policy, which in India is controlled and formulated by the Monetary Policy Committee of the Reserve Bank of India. A balance of liquidity must be maintained in the system. Neither is chronic deficit of liquidity good for the economy since it clearly stifles growth, and nor is a continued surplus liquidity good for it since it indicates idle cash in the system searching for profitable growth and investment opportunities. As far as India is concerned, there has been a huge surplus liquidity in India's banking system since May 2019, hitting a peak surplus of over rupees 10 lakh crores in the fourth quarter of financial year 2021. Even till a year ago, Indian banks were sitting on surplus funds of over rupees 8 lakh crores with few takers for it. It means that neither were the Indian corporates willing to invest and nor were the consumers willing to spend, with both therefore parking their accruals and savings with the banks. With corporates and consumers preferring to conserve their cash, it apparently reflected the decelerating growth in the Indian economy. Ironically, in the last 2 years in particular, when India's household earnings had fallen, individuals preferred to keep their savings intact by spending less, leading to a buildup of deposits and surplus liquidity in the banking system. It has been an era of unwilling lenders and unwilling borrowers too, thus explaining the burgeoning idle liquidity in India's banking system, which had peaked to over rupees 10 lakh crores and banks not really knowing what to do with it. This surplus cash meant that interest rates in India remained low, and yet there were few takers for loans from banks at that point of time. With a pickup in the economy post-COVID and growth getting revived, and also with the Reserve Bank no longer pursuing an accommodative stance in its monetary policy so as to tame inflation by restricting money supply in the system, the liquidity system in the Indian economy, in the Indian banking and financial system has now changed drastically. As against a surplus liquidity of lakhs of crores of rupees in the banking system a year ago, we actually now face a deficit in it. It is too early in the day to conclude whether the pendulum has moved from a surplus position to a deficit situation for good, but things have changed significantly here. The liquidity in the system is presently in a bit of a cusp according to our reading, alternating between a little deficit and a little surplus. And the fact is that the days of lakhs of crores of idle surplus cash lying with banks are over. And if private investments, consumer spending and government capex all gather pace, then the Indian economy will witness the return of an era of tight liquidity conditions where there could be money shortages and interest rates will remain high. It is certainly a major structural shift in the Indian economy in the making from the earlier loose financial liquidity conditions to a tight one, and from surplus liquidity sloshing in the banking system to bankers now scampering for funds in order to manage their statutory liquidity ratios and also meet their lending commitments. The interest rates in the overnight interbank lending have already gone up and they are past the Reserve Bank repo rate, and they will go up further as credit demand shoots up in the Indian economy. The newspaper reports now say that after a gap of 3 years, the liquidity in India's banking system has slipped from a continued large surplus to a deficit one. The data says that as against a surplus liquidity of about rupees 48,000 crores on Tuesday in the banking system, the system actually hit a deficit of rupees 23,000 crores the next day, which is Wednesday, which is yesterday. It sent the bankers hunting for funds, And the interbank call money rates peaked to 5.85% yesterday, which is way above Reserve Bank's repo lending rate of 5.4%. The interest rates did cool down later to 5%, but the undertone remained bullish. The interest rates have been rising due to the shrinking liquidity in the system, and this jump in rates yesterday came as no surprise to us. The overnight interbank lending call money rates have now hit a 3-year high, and with more interest rate increases by the Reserve Bank of India in the offing, these rates will only go up further. While some bankers think that this shift of liquidity into deficit territory is transient and temporary, we think that it need not be so, as is evident from the many factors which have led to this present shortage of funds in the Indian banking and financial system. And what were the factors? The first one, there has been a sizable outflow of funds from the banking system due to the second quarter advance tax payments by taxpayers, which fell due on 15th of September 2022. It will take time before such tax payment comes back into the banking system, and by then, the next installment of advance tax payments will fall due in December, thus eroding the system liquidity. It is not a short-term factor. This is going to be a recurring factor. The second factor why we are witnessing deficit liquidity is that, as in the case of advance income tax, GST payments is also on the card, and it will reduce system liquidity. The third one, as a result of sale of about $35 billion by the Reserve Bank since April 2022 till date, by intervention in the local currency markets in order to support the rupee against an appreciating dollar, the RBI has sucked out about rupees 2.75 lakh crores of liquidity from the banking system, adding to the rising deficit in the system today. The next one, the demand for loans from trade and industry has gone up, with credit growth rate hitting double-digit figures. The government is directing banks to lend generously, and there is a pickup in demand because of a pickup in growth, and that will only deepen demand for liquidity and the liquidity shortage too. Further, the government has been accelerating its capex spending, thus sucking out more money from the system. The next is that with the festival season on the cards, there has been an increased offtake of loans in order to fund discretionary festival spending by the consumers, and that means liquidity going out of the system. Then, a rising current account deficit and also a high fiscal deficit both imply a flight of liquidity out of India's banking system. The RBI has been pursuing a tighter monetary policy in order to reduce the cash flow into the system in order to tackle inflation, and that is yet another factor. And finally, according to us, the outward remittances by Indians seeking to locate abroad also adds to the pressure which reduces liquidity in our banking system. To us, this shift from surplus to deficit is indeed a structural shift in the Indian economy, from surplus idle liquidity position to a much in demand fund situation, thus causing liquidity shortages. It could be that we are on the threshold of a rapid pickup in GDP growth, which has already created liquidity shortages. The overall larger picture because of this is worth a discussion. The first point, what looks to be a little deficit in the system will become much bigger as demand for funds from the corporates, from the consumers, and from the government gathers momentum. So will be the case when growth catches pace and gives rise to the need for funds to finance growth. Thus, tight liquidity conditions will be the norm in the coming quarters. The second, with the Reserve Bank being focused on battling inflation by increasing interest rates and restricting liquidity, which by its own admission is expected to remain elevated during the next few quarters, the RBI will not be able to pump in or initiate measures to pump big liquidity chunks into the system, thus adding to the overall challenge. It might pump in money from time to time to handle temporary mismatches, but a sustained pumping into of cash by the RBI into the system is not going to happen. The third, the Reserve Bank's MPC, which has largely remained focused on managing growth and inflation in its decisions so far, will now need to also concentrate on liquidity management in the economy in order to support growth. The fourth, banks will increase their fixed deposit rates to attract more deposits in order to shore up their liquidity. The fifth, we may be facing a situation of a little deficit and a little surplus at present, but it will soon be a case of rising liquidity deficit and more surpluses. And finally, with the government expecting a pickup in growth, the Reserve Bank will need to do a tightrope walk to balance inflation control and to fund growth too. What we are seeing is a big shift which could herald faster growth in the Indian economy if demand and spending both pick up. To us, it is not just a shift from surplus to deficit, but it is also a structural change, we hope, from no growth or poor growth to better growth. We think that the deficit in the liquidity system in the country, if well managed, will ensure that growth is well supported, and it will be an era when growth starts coming back and we see rapid development in the GDP. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.